Well, good morning, traders and investors. My name is Roger Scott. I'm the senior strategist at WealthPrest. It is right now the 23rd of February. It is a Tuesday, and the market's going to open up in about an hour and 15 minutes. Now, what do I want to talk about today? The pink elephant in the room. Tech breaks down. Nasdaq 100 is now trading below the 50-day moving average. Now, I hate to say I told you so, but oh man, did I tell you so. I've been saying this for a long time. Why? Well, you see this right here. Higher price, lower momentum levels. What happens to momentum levels after we break the 50-day? We break down. We couldn't even get the RSI to 70 over here. When the index was at 340 versus here at 303, we had the RSI at 86. That's called narrowing of momentum. That's called divergence, and that leads to what we're seeing right now. And this is probably the healthiest thing for the market that we could possibly hope for. Let me show you this. Look at the number of stocks that we're trading. This is the number of stocks trading above the 200-day moving average in the Nasdaq. Let me go 20 years. Look at these levels. Look at this. We haven't been there since here. This is February. We're talking 2009. And we're just getting started. This thing needs to cool off. But look at the number of stocks trading above the 50-day moving average. We've actually fallen off pretty well from 86% to 58%. So theoretically, we could kind of stay at these levels, but I'm still very, very concerned about the number of stocks trading above the 200-day moving average, which leads me to believe we are going to go further down because this number needs to cool off. The momentum levels are just too high, and they just can't sustain the current level right now. So am I surprised that the Nasdaq is cooling off like this? Not at all. And if you look at my videos going back 2 weeks, 3 weeks, a month, 6 weeks, 2 months, you will see exactly the same thing as what I'm talking about. I alerted you to the number of stocks trading above the 200-day moving average. I alerted you to the stocks trading above the 50-day moving average and explained how it's coming down. I showed you several times the divergence between price action and RSI, and I told you that the most probable outcome would be a pull down, which is what's happening right now. Now, I like the fact that the Russell is still fairly strong. I like the fact that the Dow is still pretty strong, which leads me to believe, and the S&P, well, the S&P has 20% of the Nasdaq 100, so it can't be in one place, but if you look at it, you will see that the rally predominantly is in the tech stocks. Let me just put a 50-day moving average on here and you'll see what I'm talking about. Yeah, so it looks like we still have a while to go. If I had to make a bet, I would bet that the S&P will hit the 50-day moving average and the Nasdaq 100, where is that Nasdaq 100, will actually go all the way down to the twilight zone and almost hit the 200-day moving average. At least I hope it does because it needs to straighten out before coming up again. This momentum level needs to be taken down to the 50th, 40th, 50th percentile. Otherwise, the markets will remain stretched out, and we don't want that. Now, let's talk about global economy. Well, first of all, let's talk about news. I'm expecting the market to be a bit subdued today because we have GDP on Thursday. Usually when the Fed speaks and 2 days leading up to the GDP, markets slow down. Although I don't know if that'll happen in the Nasdaq because we have a pretty good trend to the downside developing right now. But I do have to say, usually the day and a half before the GDP, we tend to see a little slowdown in the market. So don't be surprised if we see a little bounce up today. But I'm telling you right now, I am pretty confident we're going to see a little more downside in the broad market indices, especially in the Nasdaq 100. And remember, the Nasdaq 100 holds about 20% of the stocks in the S&P 500. So if it has an impact on the Nasdaq 100, it would be almost impossible for it not to have a lesser impact on the S&P 500. And that's something you need to know. Now, the big reports, as I mentioned, we're going to have GDP and jobless claims not coming out till Thursday, and personal income. Keep your eye on that. Also, look at the bond market. The bond market has been literally falling off the cliff, which is inflationary, especially in the long term. It means interest rates are going higher. Look at this thing. It's just going down. It's going down, down, down. And the fact that the Nasdaq is going down isn't supporting this. Usually, when the markets fall, we see a rise in the bond, but we're not seeing it at all right now, which means it doesn't appear that this downside correction is broad. It looks like it's very focused on tech, which is what it should be because tech is grossly overbought right now. Now, talking about the overall stock market, I usually start with the global economy, but I wanted to go into the Nasdaq today because that's what everybody's focused on. We saw a major sell-off in technology companies, as it says right here. Tech sell-off spilled into Asia, not surprisingly. Asian cell phone maker fell 3.1%. Alibaba lost 1.2%. Taiwan computer chip maker lost 1.4%. Not unexpected. Stocks began shedding some of their gains last week after a strong start to February after rising interest rates, and the potential for inflation down the road dampened some of Wall Street's enthusiasm. Though major stock indexes remain near all-time highs. Well, not anymore. I mean, look at the Nasdaq 100. We're now below the 50-day moving average. So, but the rest of them are. So I guess I don't want to nitpick. But yeah, I mean, look at the bond market. Look at the long bond. Meanwhile, the Fed is saying short-term rates are going to stay steady, and the long bonds are falling off the cliff, which means long rates are going up. So you have short rates that are staying steady. Meanwhile, longer rates are increasing, and that's ripe time for inflationary period. Large amounts of stimulus being pumped into the economy has given some investors pause, reviving worries about inflation that has been nearly non-existent for more than a decade. Yields on U.S. Treasury bonds and notes have risen in the last several weeks as investors bet the economy will bring more inflation. Absolutely, without a question of a doubt. And yes, tech stocks have thrived throughout the pandemic, but a little too much too fast. A good pullback is very, very healthy. And I don't think we're going to see it, but if we have another major COVID rise, techs will be the first ones to rise again. But this is very expected. This is very normal. I've been talking about it. I've been telling you that the number of stocks above the 200-day moving average are near historic levels or at a decade high. I've been talking about divergence between price action and the RSI, and I've been telling you guys that the RSI couldn't even go up to, look at this, all-time highs. RSI can't even go up to 70. That's a sign for a breakdown. And inverse or negative divergence between price action and the price going higher for a while and momentum breaking down, not healthy. Not healthy at all. And it usually leads to exactly what we're seeing right now. A cool off in the RSI. Look at this RSI. It's almost oversold, and we just broke the 50-day moving average. But I think we will go to the 299, maybe 300 level before going higher again. Right now, because of what you're seeing here, it's probably best to focus on Russell 2000 stocks. Look at the Russell. We're still trading above the 200-day moving average, which is right here. We're trading way above the 50-day moving average, and smaller stocks don't have as much exposure to the large cap stocks like the S&P 500. So the Russell 2000 is definitely the place to be right now. You want to focus on smaller stocks, not necessarily microchip stocks, but smaller stocks. S&P 400, Russell 2000, that's where the action is. I want to show you something cool, really, really cool. You guys need to see this. This is my filter, and it uses relative strength. And look at the S&P 500. The S&P 500, well, hold on, let me show you the Nasdaq. So this is the Nasdaq 100. Look at 6-month gainers. This is 6 month. Look at the biggest gainers. 165%, 103%, 140%, right? Those are like the biggest winners. Let me organize it by strength. 165%, 140%, 103%. That's the Nasdaq 100. Now let me show you. Those are the biggest gainers in the last 6 months. 165%, 140%, 103%, 101%, 104, 77. That's the Nasdaq 100. The S&P 500, let me show you the S&P 500. You're going to see something really cool right now. Let me organize S&P 500. 208%, 194%, 184%, 157%. See that about 200%. That's the highest gainer we've had in the S&P. FCX, my favorite stock, gained 194% in the last 6 months, which is how long I've been covering it. So 200%, 194%, 184%. So you saw, here's the Nasdaq. 165, 140, 103, 101, 101, 77. Here's the S&P 500. 208, 194, 194, 184, 157. But now look at the Russell 2000. 8,033%, 3,091%, 1,076%. 982%, 942%. So again, look at the gains over 6 months that are possible on the Nasdaq. 165, 140, 103. Look at the S&P. 208, 194, about 150, the top ones right here. These are the top gainers in 6 months. Now look at the Russell. 8,033, 3,091, 1,076. The average stock, highest gaining stock on the Russell, gains on average. I wanted you guys to see this for yourself with your own eyes. But the average stock in the Russell 2000 gains 6.5 times as much as the S&P or the Nasdaq. All you have to do is just look at the 6-month gains. Look at that. 8,000, 3,000, 1,000, 982. Look at this. Even if we go all the way down here, we're at 407%. Look at the S&P. All the way on top, 208%. Russell 2000, folks, is where the money is. And mid-cap, same thing. You want to be in slightly smaller stocks. I've been saying this since day one this year, and that's where you want to be right now. That's where the gains are happening. Now, guess what? I found a way to spot 3 times, 5 times, and even 10-time gains in less than a month's time, targeting microbursts. That's right, microbursts on some of the world's most explosive stocks. Microbursts are quick, punchy moves in small cap, Russell, and mid cap type of stocks that can return triple-digit gains in just a matter of days. In fact, I recently captured a 414% move on CNE in under a week. Under a week. And now I'm ready to share this market trick with you. Man, I've been gearing up for this. This is going to be amazing. All brand new stuff. I'm hosting a live webinar on Wednesday, February 24th at 1 p.m. Eastern Time to discuss these little-known microbursts. Click on the link below to sign up for the event and learn which stocks I'm targeting next. Make sure to like this video and subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post new videos. And remember, just look at this. S&P 500 top gaining stock, 208%. Russell 2000 fastest gaining stock, 8,033%. Microbursts. Microbursts on Russell and mid-cap stock is where the money is, as you could see here. Would you rather have 200% or 8,000% in 6 months? Follow the link below. Check out microbursts. Thursday, 1 p.m. Eastern Time. You cannot afford to miss out. You get an hour to yourself with me, and all we're going to talk about is microbursts. Bye, guys. Check it out. Follow the link below. You can't afford to miss out. I'll see you guys soon.